Hey guys, welcome back. Wow, that was an exciting few days for IPOs, in particular Doordash, even after they raised their offering price higher. To recap what happened, Doordash had raised its offering price to $102 per share for a valuation of $38 billion. On the first day, the shares popped 86% and ended the day around $189, bringing its valuation to an eye-popping $72 billion. And now it currently sits around $186 after yesterday's small sell-off, but is still up quite substantially. By the way, if you find this video helpful, please smash the like button and subscribe. Okay, so what do we think of the stock? Is it still a buy? Well, let's do our usual 5-step analysis. So as usual, step 1. Is this stock within your circle of competency? I.e., do you know the products or services that Doordash offers and how the business work? For me, this is a yes and a no. I've used Doordash to order food, and our family business also used the app as a food vendor. The app is easy to use and the food arrives quick and easy. From a vendor perspective, it was also good as it brought us customers that we wouldn't have gotten otherwise. However, the commission was quite high. I do not know the delivery side of the business, but I do know some people who drive for extra cash. They seem to be happy to make extra income, especially during these difficult times. Next, step 2. Do you understand the business operation and its performance? Does it have a strong business model? Does it have a competitive advantage? Is it profitable, growing? Will it continue to grow in the future? So first, yes, Doordash has a strong business model. Its main business is offering a delivery platform to connect restaurants and customers who want to order food online and get delivery to their doorsteps. Doordash takes delivery fee from customers and also our service commissions from the restaurants. Its direct competitor includes Grubhub and Uber Eats, who just acquired Postmates. Although it has no real competitive advantage, it does have a large market share, controlling about 50% of all food delivery as compared to Uber Eats' 26% and Grubhub's 16%. Okay, so now that we know the business model is strong, let's look at the fundamentals to see how strong the business operations actually is. In its IPO filing, Doordash reported revenue of $1.92 billion for the first 9 months of 2020, up more than 3 times from the same period a year ago. Net loss narrowed to $149 million for the first 9 months from $533 million during the same period a year ago. The company also reported a $23 million profit for the first time in its history in the second quarter of 2020. Here, we can see that in Q1, Doordash had about 37% market share of the food delivery business. Since then, Doordash has stated that it had 543 million total orders for the first 9 months of the year, which is 300% growth as compared with 181 million for last year. Thus, that number is now closer to 50% market share. That is quite a lot of deliveries. As for valuation, at $102, Doordash was valued at around 9 to 12 times forward 2021 gross profit, compared to Uber at 10 times. Hence, it was fairly valued, though it was expected to grow at 200%. But given the dramatic increase to a $72 billion valuation on a fully diluted basis, the market is valuing it at about 17 times forward gross profit, which seems way too high, given that there's so much competition. Next, step 3. What is the current economic condition, and is it favorable for Doordash? The current condition is still quite bad. COVID cases are rising to 200,000 cases a day. Hospitals are at overcapacity. Millions are unemployed, and new unemployment claims are trending up again. But luckily for Doordash, the lockdown and COVID was a blessing for their business as it boosted demand for food delivery, and Doordash was able to benefit dramatically. With some states having restaurant closures again, Doordash could see more upside in the short term. However, with a vaccine in 2021 and restaurants being able to open up again, that may hurt Doordash's business. Next, step 4. Is there a catalyst or future event that would drive the stock price higher? Currently, Doordash is also offering delivery service in partnership with major brands including Walmart, PetSmart, and Walgreens, and offering same-day delivery. This will help diversify the business into non-food and further increase revenue. For risks, there are the usual legal and regulatory risks similar to other economy sharing apps. Next, step 5. Let's look at the technical analysis. Since this is a new public company, there's no real trading data for technical analysis. As for valuation, we definitely think it's overpriced given the business risks. It is unclear how long the surge and demand for deliveries will last post-pandemic. I suspect people will still order delivery, but others will prefer to go to the restaurants directly. Hence, I do not think their growth is sustainable. In addition, their operational costs will continue to increase because drivers will demand higher pay, restaurants will demand lower commission costs, and customers will continue to demand more discount and promotions. Thus, we do not recommend to buy Doordash as the price is too high given the risk to the business. In fact, I rather own Uber, given that as you get the food and the large ride-sharing business for a lower valuation as compared to Doordash. Now, for my final tip and reminder, be fearful when everyone is greedy. The market is super frothy right now. Doordash crazy IPO surge is a key example of market exuberance and sometimes an indicator of a market bubble or top. I hope this video was helpful. Thanks again for watching. Please don't forget to subscribe.